To President Trump and congressional Republicans, the overhaul of the tax code that became law on Friday will make the United States a better place to do business. To the rest of the world, it has the potential to challenge the global economic order, creating an uneven playing field and setting off a race among countries to cut corporate taxes. The overhaul is already threatening economic relations, adding to concerns that Mr. Trump is advancing a nationalistic agenda at the expense of other countries. European leaders this week raised the prospect of a trade battle, implying that they may fight the new tax rules before the World Trade Organization. Chinese officials are readying defensive measures to protect the country's economy and its competitiveness. On Friday, Mr. Trump again emphasized his "America First" mantra, saying at a signing ceremony that the tax bill would mean more jobs and investment in the United States. "A lot of things are going to be happening in the USA," the president said. "We're going to bring back our companies. They've already started coming back. It all starts with the corporate tax rate. The new rate, down to 21%, from 35%, takes the United States from the top of the global tax spectrum to the lower end. Countries like Australia, France, Germany, and Japan, all of which have effective corporate tax rates of at least 30%, will be under pressure to follow. It's a huge incentive to governments around the world who want to see more investment to be part of that," said Andrew Mackenzie, the chief executive of the mining giant BHP Billiton, which has its headquarters in Australia and major operations in North and South America. "They will have to follow suit." Corporate rates were already on a downward trajectory. Many countries have used low taxes as an advantage over the United States, which offers a huge domestic market, plentiful venture capital, and relatively light workplace regulation. "There will be pressure for a new round of lowering corporate taxes," said Stefano Micasi, the Director General of Assinim, an Italian association of publicly listed companies. China, a frequent target of Mr. Trump's over its trade practices, may also be forced to play the tax game. For all of its appeal as a manufacturing hub thanks to its skilled workforce, solid infrastructure, and other benefits, China charges high taxes. On top of a standard corporate rate of 25%, companies are required to make Social Security contributions and other payments that push their tax burden higher there than it is in many other countries. Last week, China's Vice Finance Minister, Zhu Guangzhou, pledged to take proactive measures in response to the tax overhaul, according to Xinhua, China's state-run news agency. The external impact of tax policy change in the world's largest economy cannot be overlooked, Mr. Zhu said, according to Xinhua. Mr. Zhu did not offer details about the measures China might take, but they could include streamlining regulations that foreign businesses face, or deferring certain taxes if money is reinvested locally, according to Andrew Choi, a tax partner for Greater China at EY. Deep in the tax package's fine print were provisions that looked like protectionism to Asian and European companies.